G'day viewers and welcome to the Motley Fool TV live stream. I'm Adam Surplice and joining me from New South Wales is our Chief Investment Officer, Scott Phillips. G'day, Scott.
Adam, g'day. I'm from the Premier State, mate. The first state. I'm not going to say it's better. I'm just going to say people can make their own judgments. You're on the Gold Coast, of course, and that's it's lovely. It's fine, but it's not the New South Wales.
No, that's right. Well, state of origin, I'd still be on your team. We're both Shire boys from the Southern Shire down there in Sydney. So
yes,
yeah,
says
I'll
everything
just switch teams depending. That's right. Now I've got to say, Scott, you're looking particularly well after a very busy earnings season. Before we dig into that, though, please note, viewers, that the Motley Fool is licensed to provide general investing advice only. We will answer your questions live, so put them into the YouTube live chat box anytime from now on, but we can't give you individual investing advice. So with that out of the way, Scott, earnings season is always a huge few weeks for yourself and the investing team. Bring us up to speed on the latest.
Man, my goodness, the last week in particular, mate, it seems to be this week of the month. This is actually the fourth week of August, because the way the days kind of falls on, we're the third week, but this week has just been crazy busy, which is no excuse, no complaint. Well, this is what we do, right? We love it, so it's all fine. But I'll tell you what, you say I'm looking particularly well. I don't know how much sleep the team are getting. I say literally the team, it's not just me, of course. A lot of people at the Motley Fool working very, very hard this month to get all of the great content to our members in a pretty timely way. I will say quickly, by the way, if you remember watching, we are trying to be timely but not fast. If that sounds weird, then good, because it's a good chance to explain it. We try and bring you information that is usable, useful, thoughtful, analytical, all the stuff, right? Readable. And we try to bring it to you in a timely manner, but we're not trying to be the fastest out of the block. Why? Because share prices respond immediately to information. So the time it would take us to read and type, even that alone, the market would have already moved. We think the value we bring as long-term investors is to really understand the information and bring it to you. I'll answer your question in a second, Anna, but just a quick one. How many people watching now heard the Coles result and heard anybody talking about the Coles earnings per share? Now, I reckon almost exactly nobody. I didn't see it anywhere in the media, anywhere in the reporting. And here's the thing. It was nowhere in the ASX announcement, the press release, in the 4 or 5 pages. It was nowhere in the presentation, the kind of fancy PowerPoint they give. You had to go to page 15 of the annual report, the financial reports, to find even a mention of it. No surprise, it was down. So that's kind of the story. Why do I mention that? Partly to say to Coles, hey, lift your game, guys. Like earnings per share, we should be on the front page, just because it's stuff that investors want to know, need to know, and frankly, you deserve, or they deserve to know. Coles should be giving it to you up front, because that's important. More importantly, though, mate, I suppose, my point is, it's that sort of work, not just Control F finding the earnings per share, but anyone can do, oh, here's what's on the front page of the press release. Anyone can do, here's what Coles, the quote of here's what Coles said. The job of the investor, the analyst, particularly at the Motley Fool, is to understand the real underpinnings of the business, what actually happened, not what management wants us to know. There's a great line about journalists. A journalist is someone who prints something that no one wants everyone else to know. And analysts aren't exactly the same. We're not that cynical or skeptical, choose your tone, but not that far away either. Our job is to understand the real fundamental underpinnings of the business and the result, what really drove the result, for good or for ill, and then share that, excuse me, with our members and our readers, and in this case, our viewers on YouTube. So that's I want to draw that out, because in the hurly-burly, hustle and bustle of earnings season, you generally get the big headline, the press release. So easy for a journo to kind of go, management said this, here's the numbers they put on the screen. We try and go a bit deeper and say what's really going on. So with that preamble, earnings season's been pretty good. I saw an article in the Herald today, and this is one thing I do want our viewers, in this case, our readers and members, to know, is the share prices respond really, really significantly in different directions to earnings. IDP Education started up 30%. Domino's yesterday down, was it 20%? Something close to that, 22, I think, in the end. We're getting really, really big swings. And that is getting, I'll say worse, getting more prevalent, I guess is what I mean by that. What we're seeing across earnings is investors are reacting, not responding, reacting in really big and extreme ways in different directions, both directions, based on, again, partly, frankly, what management's telling you, partly what they kind of had inflated or deflated expectations beforehand. Now, by the way, IDP Education profits were down, shares up 30%. How's that happen? Because market thought it'd be even worse. So the 30% sigh of relief is what happened today. The story there, excuse me, is one of really extreme responses. And Yes, I love that. I'm going to say I love that. What I love about that is it gives the investor the opportunity to take advantage of the market's overreactions as long as you stay really focused on the business itself and your process. And I have to say, look, at the Motley Fool, we try and be the best we can be. If there are some things that really kind of stand out the way we approach investing, we try really, really hard not to be swayed by the market and to be fundamentals-based investors. In other words, we're not saying, what did the share price do? What does that mean? We're saying, what were the results? What do the results mean for the share price? And does that make it an attractive time to buy or sell based on how the market reacted? So there's really big swings. It's been, Woolies was down 17%, I think, 12%, something like that. Really, really big. I think it was just Woolies, right? And the results weren't great, but it was a massive fall. I think it was 12% or a 17% drop in earnings. These are frankly, they're over-exaggerated moves in both directions. What I love about that, as I said, gives us the opportunity as investors to say, hey, the market hates that. Maybe it's not quite as bad. Or the market loves that. Maybe we get a chance to sell. And I will say in both cases, even today, for one of our services, Dividend Investor, I'm not going to give the company away, Dividend Investor released a sell today on the back of, frankly, good results from the business, but an extraordinary response share price-wise, which they thought was it's just simply overdone. And so that's kind of the story. In terms of earnings season itself, Adam, which is the question you actually asked at the beginning, I think actually pretty good. Overall, I think the response from companies to this challenge we're having economically has actually been pretty positive. There were some real concerns coming to earnings season that this would be the half of year. It's a full year result for most companies, but this last half would be the time when we really saw the color of the money. We saw how well or badly companies are responding to earnings season and to inflation, to cost, to slowing economy, all that kind of good stuff. Mostly, the results have been pretty good. Here's a really interesting thing too, quickly about earnings, and I mentioned Coles before. Coles sales are up 4.3, I think it was, percent. Their earnings grew about 11%, operating earnings. Woolies sales up 3.1%. Their earnings fell, as I said before, about 17%. Now, that feels like a really small difference at the top line. But the difference at the bottom line can be really, really significant, particularly for businesses with low margins who rely on modest profit growth, modest sales growth, I should say, in excess of costs to drive profits. If you don't get that, and Woolies didn't, their costs increase faster than their sales. That's always, particularly in a low margin business, a recipe for real trouble. So the banks were ordinary. Supermarkets, mixed. Minor results have been a bit all over the place based on commodity prices. They've been down, but we kind of expected it, so not a lot to see there. Overall, I think I would say I'm encouraged. The ASX, can I give you the final version, Adam? And I will shut up in a second. The ASX has been up 23% since the April 7 lows. So maybe we'll talk a bit about volatility in a minute, but that's a really significant increase. Now, we're almost at the end of August, so I can do the numbers now. The end of August, we're up 3.1% over the last month. Now, I would mathematically annualize that, multiply 12 is 36%. It's not going to happen, right? My point is, if share price can go up 3.1% during earnings season, it tells you exactly things weren't as bad as people expected and probably better than even some optimistic investors had hoped. So that's probably my underlined answer to your question after a never long ramble. Earnings, pretty good. The market, pretty good. Share prices, we've hit a couple of records last week. I don't think we've hit one this week yet, but it tells you the story. The market likes the results. The results are pretty good. Overall, earnings season, I think, a pretty positive one.
All right. Well, let's talk about one that the results were not that good. Hassan has asked about Telix Pharmaceuticals. So you mentioned Woolies with just a crazy drop in price. You mentioned Domino's as well with another double-digit drop as a result of reporting. And Hassan's asking about Telix Pharmaceuticals. Now, I will warn you, Hassan, I know you know this, but for everyone else, Scott's not an expert on every single Scott. We have a team and Scott may not be the one who is doing the work on Telix specifically, but do you have any thoughts around the recent FDA issues? And, maybe an explanation. I think we saw a 24% drop for Telix at one point on Thursday.
At one point, closed down 18.75% in the end. You're right, I'm not a Telix expert, not even a biopharmaceutical expert, frankly. But when you buy biotechs, what you're really doing, particularly the early stage ones, you're taking a calculated bet on the chances for regulatory approval for the drugs or the treatments that a company provides. And if they manage to find some good ones, the shares go to the moon. If they disappoint investors, the shares tend to crumble. And today, unfortunately for Telix, we saw the reverse. Now, I'll just quickly share. I'm not going to for everyone else watching, this is going to feel like a foreign language. Hassan, you'll know the story here. But so there's a biologics license application that Telix had to apply for, obviously, for a particular product. Now, basically, what happened is here's the quote from the Motley article, by the way. The company revealed the FDA's response identified deficiencies relating to the chemistry, manufacturing, and controls package. The FDA want more data to establish comparability between the drug product used in the trial and the scale-up manufacturing process intended for commercial use. That's a lot of gobbledygook, which basically says the FDA is not convinced that what will get produced matches what was tested. Now, not say it won't, or they can't change or fix it, but this is the problem when you do it in the biotech space. You are taking calculated punts on the chance of approvals, of commercialization, and profitability once that commercialization happens. No big surprise here, mate. If you followed it, you probably understand the story altogether perfectly. The fall, I just mentioned the falls are probably overdone in other companies. I suspect this fall was probably pretty reasonable for two reasons. One is it's a big deal that the FDA said, well, back you go. The other one I would say is I think the market probably had factored in I will say too optimistic view of the chances of success. And that's okay. That happens from time to time. We don't yet know what will come of this. We don't yet know what will come of other jurisdictions on the same product. The FDA tends to be the gold standard. If they approve a drug or treatment, tends to get a pretty easy run through the rest of the regulatory systems across the world. Not always, but largely. This kind of it's the gold standard. You're going to ask me, Hassan, what's next? I don't know, mate. We're in the world of who knows, because the company obviously was hopeful or positive. The FDA said no. Can they come back and prove the case? Maybe. The market, frankly, today's response, the market saying we're not sure that'll happen. So I suspect the response today, share price wise, is probably pretty reasonable given the news. The question is what happens next, and I just don't know the answer, mate. Because no one does. It's impossible to know the answer. That's the other thing with biotechs. You want to take a probabilistic view of this rather than an absolutist view, which is you can't know for sure. The people who run these companies, these are smart people, like scientists with PhDs and years, decades of experience, and they're trying to come up with something brand new. They are absolutely convinced this is the solution. So is every other biotech out there, and yet a very small proportion make it. So play this game probabilistically. Think about the chances of success and failure. Generally speaking, take a basket approach is my general view for biotechs is you can't know for sure. Here's the other thing about probabilities. You toss a coin, 50-50 chance of heads or tails. If you only toss it once, what happens? 100% heads or 100% tails. So you've got to have enough examples, enough instances in the jargon of the event to get the approximate probability. So be diversified in general. Certainly across biotech, be diversified. This is going to happen probably more than a dozen times across your investing journey if you're going to buy biotechs.
All right, and while you've got the floor, Hassan, another question, different topic, but this is about brokers and their target prices. So, yeah, explain what these target prices are that they publish and why they're all different.
Slash ridiculous.
I mean, I was going to make a comment about dartboards, but I won't. I'll let you.
So, yeah, dartboards is right. I'm going to tee off. It's a Thursday night. I'm going to have some fun. So first things first, what is a target price? A target price, okay, stupid. I'll say stupid. Outright stupid. What's a target price? A target price, it depends on the broker, but generally speaking, a broker will have a 12-month target price. That is where they think the price will be in 12 months' time. Now, I'm going to pause while everyone laughs. If you're not laughing, you should be. Who knows, right? Think about the last 12 months. Donald Trump, start there. Add any geopolitical, any economic, add inflation, add interest rates, add consumer confidence. Who knows where the economy is going to be in 12 months' time? Who knows what Donald Trump's going to do, what Anthony Albanese is going to do? Who knows what's going to happen to the Australian economy, Australian companies themselves, those companies' suppliers and customers, the tariffs that may or may not be applied. And analysts are saying, brokers are saying, in 12 months' time, I think the price of Woolworths will be $34.24. I personally think that is absolutely ridiculous. I think it's rubbish. I think it's stupid. And I don't mean to impugn any individual brokers here. I'm not going to name them because I get myself in trouble. And here's the other thing. Why do they give a target price? And one of my very, 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 very favorite quotes is John Kenneth Galbraith, who said, pundits forecast not because they know, but because they are asked. And I've said this before in this forum, and I'll say it again. I am forever grateful to Adam and the Motley management team. that don't make me go out and say, I think the All Ords will be at 9,485 points by Christmas, or I think GDP growth is going to be 2.3% by July next year. Why? Because it's ridiculous. Nobody knows, right? Why do economists do it? Why do brokers do it? Because someone asks. And the problem is when someone gives a forecast, they look at the other guy and say, well, where's your forecast then? And so the other guy says, well, okay, here's my forecast. And around we go. So it's this really silly pea and thimble trick. Why I'm grateful to the Motley Fool and to Adam, I get to say, and I regularly say, I don't know. So much so that when I'm interviewed these days, people will say, all right, Scott, I know you don't give forecasts, but, or I know you don't do predictions, but it's just dumb. There's no value to it. So let me go back then to your question, Hassan. Why do they give a price target? Because someone asks. And God love them. They provide forecasts targets because that's what they're asked to do. And so if you've got customers and the customers want something, give them what they want. Make up a number, pick a number. And when I say make up, I don't mean anyone's being necessarily, I mean, these guys spend, here's the thing, really, really, really expensive analysts spending countless hours putting stuff in spreadsheets, coming up with, I think the price will be in 12 months' time. Here's the other thing, by the way. The price in 12 months' time is not going to be a function only, maybe not even mostly, of the company's results. What investors are thinking about those results, right? So Woolies fell 12%, whatever it was, this week. They fell back to the level they were, guess when? Back in March this year. So this big 12% drop back only 5 months. During that period, they'd gone up, but across and back down again. Now, who knew that was going to happen? Who knew the price was going to jump, then stay there, then fall again? Nobody. It's impossible to know. So what do? They put the finger in the air and say, well, I don't know, I guess earnings will be 5% more and price earnings might be this and the price target might be $36, right? It's a nonsense. I really honestly, and here's the other thing, humans, and why do they do it? Because we ask. And so I'm saying, like, I love that you've asked the question, mate, but part of the reason you're asking is because someone's put a number out there. Well, maybe that's right. So back to your question, why are they different? Because different analysts have different expectations for growth and different expectations for effectively the price earnings ratio. So what is the price earnings ratio? It's the price divided by the average profit. So you say, well, I think a company's going to earn $1. It's going to have a PE of 18 times. Therefore, the share price is going to be $18. Someone else says, well, I think it's going to be $2 a share and it's going to pay 14 times earnings. So that's $28. And someone else says, no, it's $1.50. You get the idea, right? So it's guesswork, pile on guesswork, pile on guesswork. It's why at the Motley Fool, we have 5-year investment horizons, not 1 year, not 2 years, really rarely 3 years, because anything can happen in that period of time. But something company related or something not company related, something about the market. Think about the COVID crash, right? Imagine going back to March 2019 and someone giving you a 12-month price target for Flight Centre. Then you get to March 2020, the proverbials hit the proverbial and the price target's wrong. Now, what happens at that point? The analyst says, well, I couldn't have known that was going to happen. To which we should say, good point, we'll stop listening. Instead, what we do say is, oh, fair enough. What do you think now is going to happen? No one knows. So the answer is, mate, the straight answer is different earnings forecasts based on their own assumptions of how much things might grow and different multiples of earnings they think the market might pay for those earnings at some future time. Both are impossible to guess. It's a silly game to try. It doesn't stop them because people pay for certainty because it sells. I'm very, very lucky, as I say. We don't do certainty. We don't try and sell stuff we don't believe in. I'm allowed to say, I don't know when I don't know. And I'm allowed to say, who cares? It's about the 5-year thesis when the company plays out and the share price tends to follow company value over time.
And I'm glad you avoided mentioning that a skeptical observer might suggest that perhaps they're setting a price target which they would like to achieve for shares that they own or their funds own. So well done for steering clear of that controversy, Scott.
Yeah,
right.
thank you. Not only that, by the way, quickly, really quickly, sorry. The other thing is, if you ever look at the average broker recommendations, I did this numbers for consensus data a year ago or so. Of every company covered on the ASX, something like 4 had an average sell recommendation. The vast majority were buys, a few of them were holds, and almost none were sells. Why is that? Because brokers make money when you buy. There you go. Keep going.
Exactly. All right. Question from Sensei, which is about a company. LDX is the ticker code. Now, I will tell you, we haven't had this rant for a while, but we prefer company names here at Motley Fool. Scott, I'm just going to do this so we don't get the long version from Scott. But yeah, we look at companies, not ticker codes. We don't use charts. We don't use any of that, that wizardry. We look at these companies are actually doing, who the people are that are running them, what we think the investing thesis of the business fundamentals. So yeah, this company LDX,
Lumos
Diagnostics Holdings, another medical company. And I'll also point out there's 2,300 companies on the ASX, so we don't look that closely at every single one. But what have you got, Scott? Do you have any thoughts?
No. Actually, the other thing I get to say about it, I don't know anything about the companies. If I don't know them, I don't say anything. A couple of things, Sensei. So back to our broker rant. If you cover everything and someone wants to buy it, you can give them some information that helps them buy it. You make some money when they buy and sell, right? So if you have a view, it helps because then it encourages people to buy or sell. You don't really care whether they buy or sell, as long as they do something and pay you some brokerage. At the Motley Fool, we don't do a so-called coverage model. We don't cover everything for the sake of covering everything. We focus our attention on the companies we think are the best companies. We have the highest conviction in and we think can beat the market over the long term. That's not an ad, by the way. It's to explain that why we don't have a view on everything. We can spread ourselves a mile wide and inch deep. We don't. We choose to spread ourselves, not exactly a mile deep and inch wide, but some better combination of that. So Lumos had an announcement out relatively recent. Those shares have been on an absolute tear. So you probably know if you're asking about it, mate, or at least hopefully you own them for your sake. I really hope you do because on July 9, they were 2.8 cents a share, then up to 13 cents a share. So that's a nice, a 5-bagger, 6-bagger in a very short space of time. The problem is they're still not making any money. And if you think about a business in that sort of situation, this is pure hope/hype/whatever. They're losing less every year. That's a win. Last year they had sales of 3 cents a share, lost 3 cents a share in earnings, by the way, and that's the other story. Here's the thing you want to be a little bit concerned about, mate. I don't have a view on this company. I'm going to give you some broad thoughts. 2 years ago, they had 223 million shares. Now, it's a video live stream, not audio. 223 million. 2 years later, they got 513 million shares. So they have more than doubled the share count. Now, if you'd owned 2 years ago, your shareholding is now something like 40% of what it was as a proportion of the company's total shareholding. In other words, if you had a tenth of the company, no one did, a year ago, you've probably got about 4% of the company now. You've been massively diluted. Now, if you haven't owned, you don't necessarily need to care about that. My point, though, more broadly, is that's the sort of thing that really does tend to dilute earnings, or why it's always really, really tough to stay invested in these sort of companies that dilute over and over again. So I just gave you those details. Here's the other thing. Revenues, 2 years ago, 16.9 million. This year, 16.8 million. So again, some revenues, but dead flat, yet you own much less of the company because, why? They've diluted your shareholding. Now, hopefully they use that money for good, not for evil. Hopefully things have improved. And I don't know. I'm not casting any aspersion on the company whatsoever. I just don't know the business well enough to have a view. The challenge you've got to be careful of, though, is even if you're right eventually, if you get diluted, it's very, very hard to make the money back. Back on the 9th of July, I'm trying to find the information here. They signed a deal with, here we go, pulling it up right now. How's this for live? A US distribution agreement. Now, if you can get, Phase Scientific was the company, February DX is the product. The holy grail for most biotechs, we just talked about that, is getting distribution. Most of them won't do their own distribution because it's just too hard to do. What you want to do is create a great new product, find someone else to distribute that product for you, and then you're off to the races. And that's exactly what happened. That announcement saw the shares up almost 5-fold. It's a really great result. If you're a biotech and you get to that point, someone says, yes, I will distribute your product. That's brilliant. So really, really great for the company. Really pleased they've done so well. Hopefully things start to improve for them. Hopefully the results continue to do well. The challenge, I think, is they released their results today and the shares jumped 3.8%, which is something. But what it really says is the market's kind of already priced in the news. And that's okay. The question from here is what's going to look like. Back to my first answer, I don't know. I don't think it's reasonably probable that you can have a accurate view on this one. So you're kind of in lotto ticket kind of territory. Maybe it's great. Maybe it's not. Maybe it's somewhere in between. Hope springs eternal too, although if you look at these sort of companies, most people look at that and go, oh man, it's 13.5 cents. If we got to $1, if we got to $2, if we got to $5, look how much money I'd make. As I like to say, if your grandmother had wheels, she'd be a bicycle. So if is the biggest small word in the English language. If this happens, and anything could be true. I don't know how you handicap the odds of this one. I'm not going to invest in it until I have a reasonable assessment of how I can handicap the odds. Otherwise, it's a I'll say it's a gamble. I don't mean that. I'm not being anything different negative about the company, by the way. Really, really clearly, the company's doing what it's doing and doing as well as it can. You're betting literally on the future, not being able to assess the probabilities, in my view. Why? Because even the smartest people in those companies still get it wrong every time, most times. Why? Because there's just so much that can go right, so much that can go wrong. So sorry, I can't give you a better answer. Just be very, very careful with these sort of companies. They are lotto tickets. If you want to buy them with lotto ticket money, knock yourself out. I wouldn't buy them with investing money because there's a very good chance you lose some or most or all of it.
Yeah, but if you have a feeling or you have thoughts, it doesn't hurt. It doesn't escape us that you've got a couple of Lambos there in your profile picture. So
there you go.
We've all been. I've
What
been
am I
guilty as
doing?
well. There's, but yeah, I guess my personal view is keep your investing separate from your play money, your gambling money. But
Perfect.
hey, nothing wrong with having a bit of a punt. All right, now, Scott, before we go to a couple more questions, your favourite topic, interest rates. Now, okay, just bear with me. I know you don't do forecast, but the RBA reduced interest rates earlier this month. They've established a pattern. I'm sure it hasn't escaped people like me who like to look for patterns. Basically, every second meeting in 2025, they've reduced by 25 basis points. So I'm not going to ask you for a forecast. Instead, you mentioned at the start of this that earnings season has generally been good for Australian businesses. So how much of that positive result do you think can be attributed to those interest rate reductions?
Oh, heaps, actually. That's a really great question. We've seen house prices tick up every single month, 6 months in a row. Guess when that started, when rates started falling. Consumer confidence is the highest it's been in years. Why? Because rates have started falling. I say regularly, when I do media stuff, one of my favorite stats is consumer confidence or business confidence or both. Why? Because every other stat we look at, almost every stat goes backwards. What was GDP last quarter? What was unemployment last month? What was inflation last month? I'll get back to that. So that's, it's very reasonable. You want to report on where we've been. Makes sense. Confidence looks forward, and it looks forward because the numbers themselves are survey numbers from last week. That's true. But what is confidence? Confidence it governs how we then behave. I've probably said this before, Adam, if I have, stop me. But effectively, if I feel good about the future, I'm going to go and spend. Why? Because I think I'm going to keep my job. I expect to be paid more. Inflation's coming down, interest coming down. I feel good. So I go and spend. When I go and spend, what happens? Well, the economy grows. The economy grows, so I keep my job. And I say, I was right. See, I went and spent money. The economy grew. I was right. If I feel bad about the economy, if I'm worried about losing my job, if I'm worried about inflation, interest rates, if I'm worried about what might happen next, what do? I keep the money close to the chest, keep the wallet closed. I don't spend. What happens? Well, the economy stagnates. And I say, see, I was right. The economy stagnated or it fell. I was right. So confidence is a self-fulfilling prophecy to the most part, particularly when it's meaningfully high or low. And so it's not perfect, but it's a pretty good indicator of what we're going to do. Because we're not silly. If we think it's going to fall, we don't spend. If we think it's going to go up, we will. So to answer your question, that's exactly why we've seen people go out and spend. Retailers have had a pretty good last half, generally speaking, for most that go Woolies apart. Most discretionary retailers have had a pretty good time of it. Not everyone, and there's issues in individual sectors and states, frankly, in Victoria. But broadly speaking, things have been pretty good. So you take that information and say, well, isn't that why things have gone well? Yes, absolutely. The problem we've got, Adam, and I know you know this, but I will talk about inflation for a second. We had the inflation numbers out yesterday, and they were ugly, like ugly. I'm an optimist by nature, and I try and, if I'm ever asked about it, give a balanced view, not a 50-50, but here's what's good, here's what's bad, or here's the headline, but here's what else you should be mindful of. I think we try to educate at the Motley. It's part of the job, right? So rather than here's the number, it's like, well, here's what you need to know behind the data. Yesterday, there was no good news. I couldn't find a single good data point to talk to. And here's the numbers really quickly. CPI went from, this is July 2025. In June, it was 1.9%. The following month, the annual number, the 12-month number, had gone from 1.9 to 2.8% in a single month. That is extraordinarily large. Economists were expecting an increase maybe to 2.3. It blew that out of the water, more than double the difference. The trimmed mean, 2.7, up from 2.1. And the excluding volatile items, petrol, fruit and veg, and holidays, was 3.2% compared to 2.5% the previous month. These are ugly numbers. So I'm not going to do a forecast for you. I suspect, though, to your point, by the way, seeing the patterns, that's absolutely true. I'm absolutely sure the RBA said slow and steady wins the race. Every couple of meetings, every 3 months, well, we can. We'll lower rates if the coast is clear. We think inflation's under control. We think we're going to get back there. So we can afford to just slowly and steadily reduce it as we go. Gives us time to look and see what happened and how the markets responded, how the economy's responded. But every 3 months feels about right. And I think that's perfectly reasonable. I've got to say, I'm not going to make a prediction, but these numbers really would have had the Reserve Bank kind of choking on their morning coffee when they saw this come out at 11:30 yesterday. I'm not saying it's going to change anything necessarily. They might still be okay with it. They are expecting inflation to lift. They said that themselves when they made the last decision to cut rates. But I've got to say, if you were desperately clinging on to the hope of a rate cut in September or November, I would September, I don't like your chances. November, again, I'm not going to do predictions, but if you're a bookmaker, you're probably lengthening those odds a little bit. Not extra. I'm not saying it's not going to happen. But if we get another monthly one between now and then, it's ugly. It's heading the wrong direction. So I am a little bit concerned about it, mate. We've talked about this before. Tariffs globally are going to push inflation. They have to. By definition, you're adding money to the price of something. It is the night follows day, right? How much? I don't know. But it's going to put inflationary pressures on. It's going to cause dramas. Excess demand or extra demand from rate cuts. The RBA knows this. It's why they held rates for so long. They didn't want to stoke inflation. Arguably, they kind of have. And that's okay because they need to get back to neutral rates at some point. But yeah, these were really, really bad numbers. Electricity up 13%, housing up 3.6%, food and beverage up 3%, grog and tobacco up 6.5%. So yeah, I'm not a doom and gloom, mate. I like to find the good news. I like to be the optimist. There was nothing. I could say maybe it could have been worse. That's the best I can say for the data. I'm not even sure it could have been. The jumps were massive month on month. So we're going to have to buckle up, I suspect, and see what happens. Yeah, still no prediction on the RBA, but it's much harder for them to cut rates if this continues than previously was the case. Put it that way.
All right, and I think I deserve an Academy Award for getting that question out without actually asking for a forecast. And you,
well done.
I don't know, feel like you gave us a little bit of one, so I'm happy with that. Well done. Okay.
Thank you.
These YouTube names crack me up. We've got Grandpa Barbecuer asking, I'm considering long-term in data centres and gas due to their high energy use. I have a data centre in mind. Your thoughts?
So I
like the thinking.
Can I fall on my sword? I've been wrong on data centres for the last 10 years. As investors, particularly when you're a fundamental-based investor, you're looking for competitive advantages. Now, a data center is a data center is a data center. I mean, if you're a high-frequency trader, you want to be a little bit closer to the exchange than everybody else. If you're doing just general stuff, AWS, Google Cloud, AI, the extra nanosecond it takes to go another kilometer is just nothing. It doesn't matter. If you're a high-frequency trader, it's all about speed, right? So you want to do that. For everyone else, it doesn't matter. So my data center and Adam's data center is the same as John's data center and Jane's data center. They're all the same. They're a dime a dozen. Who cares? Where is the competitive advantage? So I said, well, data center investing, stupid idea. I was wrong, so badly wrong. And what I got wrong was the demand outstripped the supply. I think in the fullness of time, you're still playing chicken with these things. I think when we level off, someone's going to say, aren't they all just real estates with computers inside them? And the answer will be, yeah, that's exactly what they are. It's entirely what they are. If you can invest though at a time when, you got to time this, which is always challenging, right? So that's why you got to be careful. If you can time it, while ever demand exceeds supply, you should see prices go up, margins stay high. Data center operators should make a lot of money. So I was dead wrong on that for ages and ages and ages. I still think you want to be very careful because if you get caught owning these things when growth slows, you potentially, if they're selling for high multiples of earnings at that point, there may well be a reckoning. So let me put that on the record now, which is not to say I wasn't wrong. I was dead wrong before. And I think there's an opportunity now. So I'm not saying don't do it now. I'm just saying be very, very careful. If you buy it, G8 Education, childhood childcare center place. For years, they grew and grew and grew and grew. And the market got excited. Oh, this is a growth company. Great. It got to a certain size where it matured. And there wasn't much market potential left. And what happened? Well, growth was modest, which is fine. But as growth moderated, the PE went from growth to, it's a pretty mature company. And that fall hurt a lot of investors. So just be really careful there with the way you think about data centers. But I suspect for the foreseeable future, data centers have a pretty bright future in terms of that demand exceeding that supply. Why? AI, cloud computing, this thing is exploding. You all know that. Well, AI is a thing. So I do think I was. Oh, I'm sure I was wrong on data centers, and I think they will make money for investors for a while. As companies, still careful of the share price you pay. My mistake was looking at the fundamentals saying it couldn't work. Doesn't mean any price is okay to pay. I will tell you, I think I can do this. One of our recommendations of the Motley Fool Share Advisor is Goodman Group. Now, they're a property developer / manager. I love it as a business for what they used to do. I love it even more, or maybe as much, for what they're moving into, which is data center creation and management. A couple of reasons there. Firstly, they invest in the data centers themselves, but Goodman's model also has them as the manager of the asset and the trust. So they take external money in, they put some of their money, a whole lot of other investors' money in the thing, put it in a big pot, invest in an asset, a data center, for example. They get a return on their money, plus they get a fund manager-like return to manage the asset moving forward. So you get this really, really nice model where, yes, you put some of your own money in, and the returns on that will be okay, but super capital light. In other words, you pay not a lot of money to own the management rights, and that's just money for jam. That keeps trickling in. Greg Goodman, who runs this business, started up, has done a spectacular job. So if I'm going to play data center, I'm going to do it through Goodman Group personally. It's not a pure play data center producer. There's NextDC and others out there. I have no strong view on it, NextDC, but I do know I love the way that Goodman Group runs its business. No promises, no guarantees. I own a few shares myself, for the record, not a lot, but a few. So yeah, I think Goodman is my choice for the data center play. I think if you want to be involved in that, they've got lots of opportunity ahead. I think they're a very well-run business. They've diversified as well, by the way, so you're not putting all of your eggs in that basket. That probably lowers your total returns if AI is the thing, and you've got these bulky goods retailing and Amazon warehouses. Maybe the upside's not as massive as if you have pure play, but you diversified, the downside's not as big if it goes wrong too.
Yep, all good comments. And yeah, I think NextDC is the obvious one that came up as an Australian company. I'll just add to that, in a previous life, I used to manage IT projects right around the time when moving offshore data centers was the fashion. I would say make sure you look at the use case of that data center. So, I mean, NextDC is never going to compete with Google, in AI data centers, but there's always going to be a need for, secure hosting of customer records, banking transactions, airline booking sales. Look at the use case that they specialize in, figure out what they actually add value, where they add value, because, a data center ain't a data center anymore. There's many different types. You've got your massive facilities built into the basements of mountainsides in the US, and then you've got the smaller, more specialized ones like NextDC. So understand the business and understand that they're not all the same. All right, Scott, I've got a question I'm going to hit you myself with, which was sort of an amalgam of a few different questions that we've had. Hang on, let me just find the banner. This is it was an article from back in February 2025 in the AFR, and it didn't get a lot of traction. The main quote is, superannuation fees cost us $100,000 and many don't even know it. So when you delve into that, and I hesitate to use the word delve because that's a sign that I could be an AI robot, but when you look closely at the argument, it's that, superannuation is costing the average Australian worker $2,000 a year in fees. The fees are opaque, and so over a 50-year career, you're spending $100,000 of your retirement savings on fees to manage your superannuation. And that's before you even get to the compounding effect. So it's going to be many multiples of that. We're talking hundreds of thousands of dollars over your whole career in current dollars. Yep. It's opaque, so we all just forget it exists. What can we, your average Australian worker, do about it, if anything?
So I hate the fact that super costs so much, Adam. Look, we give investment advice. We don't manage money. Others who manage money would tell you how wonderful they are and how many services they're providing, how important they are, and all that kind of stuff. Never, ever, ever forget the great book by Fred Schwed, which is a great name in itself, Where Are the Customers' Yachts? And the story goes that the fund manager or the broker takes his mate down and says, looks over the harbour and says, look, that's my yacht, that's my mate's yacht, and that's the boss's yacht. And looks at him and says, where are the customers' yachts? In other words, the money's being made by the financial industry, not by the punter, not by the average person. And it was true then, and that must have been written, was it 100 years ago? Pretty close. Every bit is true now. The financial industry takes way too much money out of the average Australian portfolio, whether it's super, whether it's private, all that stuff, right? Why? Because they can. Here's the other thing. If percentages feel low, right? Oh, only 0.5%, only 1%. That's not much, is it? Adam's just giving you the numbers. That is what's going on. And it's massive. And it's way, way, way too much. The other thing is, imagine if you had to pay a check for what you got rather than have it take out of your account. Would you pay that? Would you just sign that check? I know. Kids ask your parents what checks are. Would you sign that check every year for 40 years or 50 years and pay 100 grand? No, of course you wouldn't. What am I paying that for? But it comes out of your account. You don't even see it. Unless you look at the super report, you see your total balance. You don't see what happened below the line. So it's beautiful if you're a fund manager, beautiful if you're a super fund. You take all this money out, no one notices. How good's that? The system is way below what we would consider optimal. Now, I'm going to get back to the question, Adam. What I do want to make sure people understand is for all of that, a pox on all their houses, but for all of that, please, 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 please don't give up on super. Because despite that, super is spectacularly tax advantaged. Even with the changes, we've spoken about the changes before, that are planned for superannuation, it is still far better than investing outside super. Now, I have money inside super and outside super. I do both. Why? Inside super is super tax effective and I'd be mad not to. Outside super gives me flexibility. If I want to take some money out before I retire, before I meet a condition of release, as the Boffins say, I can use that money. So I'm hedging my bets a little bit. But please, please, please don't give up on super. It's imperfect. It can be fixed. It should be fixed. I'm happy to rant about all the ways it should be fixed at a different time. But please don't use that and go, those so-and-sos are ripping me off. I'd say the word bastards, but I'm not supposed to. Are ripping me off. And so I'm going to take my money out of super. I'm not going to contribute to super. That's ridiculous. I'm not going to do. Just be careful. Don't cut off your nose to spite your face. Really, 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 really important. So please don't give up on super. The answer to your question, Adam, and this is what every single person watching should do, is make sure you have your superannuation in the right vehicle for you. Now, if you don't want to manage your own money, if you hate the idea, frankly, you're probably not watching this now. But let's say it's your mother, or maybe my mother. A super fund is great for them because it takes all the worry and hassle and paperwork out of the way. It's done for them. Yes, they're paying too much in fees, but it's better than doing nothing, and that's still good. Even better is taking control of your own super if it's right for you. Now, I'm going to say something controversial here, and Adam will cut me off in a minute. I think there are too many SMSFs out there. How's that for saying, I'm in the finance game, right? I'm supposed to say it's great. There are too many because too many people want to do it, mostly because they're investing in single properties, which is, I think, suboptimal. Secondly, they want to take control, but are they really good at it? Do they want to do the paperwork, all that kind of stuff? Probably not. Again, if you're watching this, that's not you. So this is really, really important, right? I'm not saying people should have, if you're interested, if you're engaged, if you want to do the work, you want to pick your stocks, you want to choose your investment strategy, SMSF is brilliant. So I'm not saying you shouldn't do it. I'm saying there's too many that other people shouldn't do because they're not really doing it for the right reasons. The accountant suggested it. The financial advisor suggested it. They're probably clipping the ticket, by the way, speaking of fees. So they went, I guess I should then. Yeah, way too many. But choosing the right super fund for you is really, really important. So if you are going with someone else's fund, please, I won't say it's true in every single case, but we know from the data for years, a retail super fund will cost you more than an industry super fund. Why? Because they're a for-profit fund and you're paying their profit margin. It's not rocket science, right? So please don't be in a retail fund unless you've got a very, 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 very good reason to do so. Why pay funds for the sake of getting the same thing? So that's the first thing. And by the way, every year, industry funds, I'm going to say 7 or 8 times out of 10, or 7 or 8 out of the top 10 are industry funds. The weight of the data is so overwhelmingly clear, it's effectively a non-starter. Just get an industry fund. If you hate the idea of industry funds being tied up with unions, I think that's a silly thing to worry about personally. That's just me. If you've seen or heard me right, I'm pretty frank with my views. I don't have a dog in either fight. I'm not pro-union or anti-union. I'm not pro-industry fund. Just whatever, who cares? If you get out of a retail fund, get an industry fund. If you don't want to be an industry fund that's tied up with unions, if that's your ideological view, you do you. If that's the case, find a not-for-profit, non-union affiliated fund. Australian Retirement Trust is one. Vanguard is another. There's a few out there. So if you don't like industry funds, don't make that an excuse to stay in a retail fund. Do it yourself. Thirdly, if you're watching this, you probably care about your money. Do your own numbers. Don't just jump into an SMSF for the sake of it. It might be bad for you, but it's probably not. If you've got a decent portfolio, if you're adding to it for the remainder of your working life, do the numbers and see if an SMSF is right for you. Here's the biggest reason why it works. Almost all funds charge you an admin fee, sometimes a weekly fee, and then a percentage of funds under management. You mentioned before, Adam, as you compound your super, your fees go up. Now, think about this. Does it cost them more to manage my $10,000 than Adam's $1 million? No, not a cent more. Why? Because they're bundling up together anyway and just averaging the fees. So my $10,000, I'm paying $100 a year. Adam, all of a sudden, is paying 10 grand a year. You think, well, hang on, how is that fair? Now, as a percentage, it's the same. Adam's mad if he doesn't take his money into something that either doesn't have a percentage fee or in superannuation, because SMSF, because it makes more sense for him. And these days, I'll give us a plug. The Motley Fool's got great services. I don't mind doing that. I'm happy to give us a plug. Got some great services designed to help you make your own decisions if that's what you want to do. So be proactive. Adam will know this. He'll mention if I don't. I have a hashtag, get a better rate, whether that's super fees, insurances, mortgages, electricity, phone, everything else. Get the best rate you can. Why? Because they don't need your charity. The banks don't need your charity. The super funds don't need your charity. You need to go out and get what's best for you. So it's a bit of a rant. So if an SMSF is right for you and you've got a decent balance, that's almost always the most cost-effective way with a decent balance. If not, please be a not-for-profit fund. Industry fund, non-industry not-for-profit fund, I don't care. Vanguard Australian Retail Trust, our default fund at the Motley Fool's Australian Super. It's an industry-related, union-affiliated fund. I don't care. I'm just in it for the low fees. Don't let the other stuff kind of knock you off just doing the best for you. Don't cut off your nose to spite your face.
All right, brutal honesty there from Scott. Okay, now I'm gonna
Unusual.
All right, this is another question, and I put it in all caps because it's a loudly asked question lately. Look, we're seeing an increasing number of articles in the press. There's one in AFR today. There's one in the Guardian a couple of days ago. So mainstream press. The theme of these articles are generally the same. It's that some of these AI companies' valuations are priced for just this absolute perfect execution of a AI-driven future utopia. But the products that they're putting out, they're not plateauing yet, but they're certainly showing signs of decelerating in their progress. The large language models all still hallucinate. Cars are still not driving themselves. None of these AIs have cured cancer yet. So, Scott, I'm not going to ask you whether AI is going to actually fulfill its promise. That's a technical question. But my question to you is that if AI is actually plateauing right now, what's the financial fallout going to be? Is this going to be the .com bust all over again?
No, I don't think, hopefully. I don't do predictions, remember, but no, I don't think so. I want to break AI up into a couple of different things here. You've got the technology itself. And Adam, to your point, I'm not a futurist. You know more about AI than I do. I'll ask you to answer that question rather than me. But I will say, if you haven't used AI recently, please do. If you haven't, I've used it on and off over the last 2 years. I said on Twitter, and I think I did on email to our readers and members recently. I was wrong on AI. I've written a lot of things today, mate. Thanks very much for bringing all these up. In the sense that I said it was May 2023. I was like, so look, AI is cool, but really it's just a natural language search engine. What the heck is everyone getting so excited about? And that was true at the time. And I did say, to my credit, maybe things get better, but right now that's all it is. I was right on both. So I was wrong on both as well. That's all it was at the time. Just look cool. Instead of asking Google a question, you ask AI, it gives you a paragraph rather than a link. Okay, well, it's kind of cool. If you've played with it recently, I say play with it, it sounds like we use it often for work. If you use it recently, the progress has been really impressive. Now, maybe it's plateauing, maybe it's not, but I use it multiple times a day for all sorts of stuff. Personal, business, so cool. We've got an internal one that we use at the Motley Fool. It's a private sandbox area. We use it all the time. It's so good. So that's important. What I think it's worth looking at, though, so that's the AI technology itself. There's the AI stocks, right? There is the kind of whether it's the chip makers, whether it's businesses promising the next big thing in AI, trying to use AI for all these things. That's its own story. And then let's go back to data centers for a second. For all of that other stuff, if I look forward 5 or 10 years, I'm going to make the easiest bet in the world. We'll be using AI a lot more in 10 years' time than we are today. And if that's the case, let's go back. We talk about mining. We talk about there's the miners, and that's what we call the picks and shovels. Those who are supplying the mining industry. Often that's mining services companies or testing companies or something else. They do the work that helps the miners, right? That's often where the money is made. The story goes the gold rush. It wasn't the gold miners who made the money, but everyone who sold them the picks and the shovels. That's why hence the phrase the picks and shovels plays. I suspect AI, which is what that says, we're going to make so many more AI-based queries in a year, 2 years, 3 years, 5 years, 10 years, whatever, because it's so incredibly useful. And I've talked about this before. I've said, look, regardless of whether the AI companies win, I think AI is going to be probably like the internet. Were there internet companies that won? Kinda. We call Amazon an internet company because it uses the internet. I'm a shareholder, by the way. So, but it's a retailer, right? Is Apple an internet company? Well, kind of. It uses Wi-Fi and 5G, but it's a handset company and a services company. What's the commonality there? They use the technology. It wasn't the technology itself that won. Well, I mean, it did because it was universal, but the companies that use the technology best were the winners. So I suspect, and again, mate, I'd love to hear your thoughts actually, but I suspect AI has a really, really bright future in terms of the number of queries, the amount of time, the amount of stuff we put through it, the way we use it. One of our team, Mitch, I'm not going to give it away here, but he shared with you and I, Adam, recently a video. He's done a quick 5-minute thing of like, here's how I'm using it to do some really, really cool stuff. I'm like, and it's part of automation, it's just AI, but the combination of that's like, man, you can do that with like no human interaction. That's amazing. So we're going to find use cases for the stuff. I'm super bullish on the use of AI right across business, the same as I was and we should have been on the use of the internet. Back to grocers, Woolies online sales are growing at 6 times the rate of their total sales. Coles, I think it's about the same, a little bit less, I think 4 or 5 times. I mean, that's phenomenal, right? Woolies is growing sales at 4.3%. Their online sales grow at 24% or something. Just mad. And so think about that over time. As that becomes 24% of a small number, growing and compounding, chasing a big number, growing at 3%. Yes, that's right. The share of sales at Woolies, $1.09, I think it is now, is done online. This is a grocer. Think about other retailers. Think about other businesses. The Motley exists online. If AI doesn't have a similar experience in 5 years' time, I'll be incredibly surprised. And so the companies that use AI best, I think, are the ones that are going to have the lead. Not necessarily even have the best AI, but use it the best. Really, really important difference there. So it's the use case, their ability to find the right applications, to use it to make it more efficient, quicker, better customer service. Temple and Webster saved a massive chunk of money last year. They announced the middle of last year. They'd saved something like $4 million a year using AI for customer service. They're using it for photos, for descriptions. The amount of things you can use it for are almost endless. So I am super bullish on the use of AI. What does that mean? Well, do I know which company's going to win? No, absolutely not. Is it OpenAI? Is it DeepSeek, the Chinese mob we talked about a few months ago? Is it something we've never heard of yet? Does NVIDIA retain its lead and go to the moon? Maybe. Does some other, cut price chip maker come and steal some of its lunch and hurt its margins? Maybe. I'm not playing either of those games of who's going to win AI or who's going to win the chips. But if you think about what does the picks and shovels play? Yes, it's chips to some degree. It's probably the data centers, right? That's why I like part of the reason I like Goodman is whoever wins the chip war, whichever AI wins the LLM war, or not even LLMs, right? AI is so much broader than that machine learning, the whole, it's massive. What are they going to do? They're going to need data centers, right? So if we're going to play this one really early on, you don't have to be at the bleeding edge. You can simply take a bet on the number of queries continues to grow. Whatever happens with the next ChatGPT, the next Claude, the next whatever else it is, if the number of queries grow, someone's got to process those queries. What chips they're using, I don't know. What data center, I don't know. But the whole thing grows. It's a pretty good place to be. So I'm massively bullish, mate. I've written about it recently. I continue to be a massive believer. I love the tech. I'm a techie, kind of not a techie like you, but I'm an early adopter. I love kind of gadgets and tech. So I love what it's doing. But the number of times I'm using it in a given week have just exploded, even over the past 3 months, compared to where they were 3 months earlier and then a year earlier. It just continues because it's getting much better, much easier, much more reliable. Not perfect, still hallucinates, all that kind of cool stuff, but it's here to stay and it is going to revolutionize the world. Mosaic brands in fashion went broke. Why? A lot of reasons, but largely because they didn't have an online presence. Now, we are 20 years in the internet revolution. They still hadn't got it right and they paid the price. The companies that use AI best, I'm sure, are going to have a great lead. Hard to find, hard to know for sure, but look for that growth, look for that leadership, look for that compound returns of we're doing a thing and doing it really, really well. It's how Amazon took away from Walmart.com back in the day. I think we'll see the same with AI. So keep your eye on that. I don't think you need to play the AI pure plays at all. You can if you want, and I'm not saying there's nothing there. Just even if you don't, look for them as they're using AI and utilizing it to beat their competitors. Because if they do that well, the thing about AI, it's super self-reinforcing. So once you get that lead, very good chance you take off at a rate of knots from your competitors.
Very good. Okay, we've got time for one more question, and it's basically the Hassan show tonight. Another question for Hassan. Time permits. Yes, it does. Do you think there'll be any bright future for stocks like Domino's? So obviously Domino's, we saw that sort of disappointing earnings. Flight Centre's had a bit of a rough year as well. What are your thoughts on those two, Scott?
My goodness, I own Domino's shares and I've been disappointed for ages. Really disappointed. And I think the answer is yes, but I'll put an asterisk on this one. Quick analogy or quick example. I recommended a company called Challenger Financial. They sold annuities. Again, I might have told this story before. I have done many stories, so you've probably heard them all before. Annuities are products that you sell to people who retire when they don't want the risk of volatility of the share market. They just want a stable income. Now, I think annuities are terrible products to buy, by the way, because it's effectively an insurance product. The insurer gets a massive clip, and you don't know how long you're going to live, so they're betting against you. I'd rather we have a service called Motley for everlasting income. Do that for retirement income. There's an ad. But so I think it's a terrible product. It's not great for the, and I'm not just challenged by that, annuities in general. So what are they? You give them a lump sum, and they promise to give you a certain amount of money every year till you die. That's effectively the way it works. Now, if you live for a year, they make a squillion. If you live for 40 years, they lose money. They've got really smart people doing life expectancy charts and working that stuff out. They take a clip of the ticket, and they rely on people saying, I don't want the volatility and the hassle. I just want to know I'm getting what's effectively a pension until I die using my own money. That's kind of what an annuity is. So I don't like the product, but so many people retire. The boomers are retiring at a rate of knots. They, generally speaking, don't love volatility. Now, again, people watching this don't have that issue necessarily. Maybe you do. Other people, again, my mother, for example, would happily, if I wasn't around, say, if I just know what I'm getting every month, I'd be okay with that. So the annuity idea is just an absolute Monty, right? If you can convince a whole lot of superannuants to do this instead of managing their own money, then you'd be off to the races. The financial advisors love them because they're easy things to sell and recommend. So I was like, well, again, don't like the product, but I get the idea. I get people are going to love this thing. I'm going to buy the shares. It went terribly. And the reason I bring that up is because you look at it and go, how can you screw this up? Now, I don't mean too harsh on Challenger, but effectively they didn't manage to get the growth that they had in them. Now, yes, they got it wrong, but I'm not sure whether I got the thesis wrong or they just simply couldn't execute as well as I thought they could, or they just didn't execute well at all. Let's go to Domino's. I think it's the same situation, but I'm still hopeful. The economics of a franchised pizza seller are phenomenally good. Phenomenally good. They're super easy to cook. You need a tiny store footprint. You want them there hot. They're easy to transport. They're flat. They pack beautifully. They stay hot for a reasonable amount of time. If you've got some McDonald's chips delivered, you know what that's like. Pizzas come much better. So Domino's is one of those things, but they shouldn't be able to screw it up. If you do it half well, how hard is it? You're the leading player. You've got market share up the wazoo. It must be 90% plus market share, I suspect. Maybe it's less than that. But of the big chains, you're massive. And every time you grow, you make the case for more franchises in between the ones you've already got. So there's one over here, one over here. Let's put one in the middle. If sales are growing fast enough, not only do you justify the one in the middle, but everyone now gets their pizza more quickly because there's a store closer to me than there was a year or 2 years ago. In my local area, there's 3 Domino's where 6 years ago, 7 years ago, there's only one. So I'm getting my pizza more quickly than I used to. It's hotter. I'm happier. How can you screw this up? Now, to be fair to Domino's, they didn't screw the Australian business up. They screwed up the international business. And that's the other part of this one. So I know I'm tight on time, Adam. I'll shut up. They should be able to get this right. The Australian business has been really good. They should be able to continue to do that well. I'm hopeful that just some good execution on the model is brilliant. So all you do is execute half well. Jack Cowan, the executive chairman, the Jack of Hungry Jacks, is now basically taking the reins like, I'm going to fix this, guys. I love founder owners, or at least kind of, really, really deeply engaged owners. So I'm still optimistic they'll get it right. Flight Centre, revenue was up. Total transaction value was up. Tariffs got them. Middle East tensions got them. I'll give this one away. It's a hold for us at Share Advisor right now. I'm not sure the value is spectacular, but I'm not sure the business is dead. I think it's got a pretty good chance of doing okay. We want to see some more traction or a cheaper price before we upgrade to buy. There you go.
All righty. Well, that's all we've got time for. Thanks, Hassan, Sensei and Grandpa. It's been a pretty small turnout tonight. I don't know if Thursday is the best night for these. Okay. But hey, we've had a great conversation anyway. But I think you can probably expect us back earlier in the week next month. We tend to get more people along to these, and that's our goal, is to help as many people as we can. So once again, Scott, thank you for your time. You're an absolute national treasure, and we're all, you tell it like it is, and we're all better off for it. That's it from us. Don't forget to subscribe, and we'll see you next month.
Cool on.